What is going on, everyone? I am Tony Pawlak with Real Life Trading, and today we're going to dive into a highly requested topic. What are options and how can you use them? So I want to cover a little variety of topics here of kind of different ways you can jump in and utilize options right now. So hopefully this is beneficial to you. We've got some of my friends here live in the room with me, so we answered some of their questions as well. This would be a fun, quick video. So first things first, you know me, I'm going to go off to my little whiteboard here and I'm going to jump in. And what the heck are options? What are options? So with options, you've got two things. You've got calls, okay? Calls, and I'm just giving you the bare minimum rundown of what this is, right? Like, this is basic of all basics. There's so much more into this, but I'm going to teach just the simplest of terms, okay? Calls, basically, they increase in value as the stock goes up, okay? They decrease in value as the stock goes down. Puts, and I'll dive into what these are a little bit more. Puts increase in value as the stock moves lower, and they decrease in value as the stock moves higher, okay? So you've got these little two inverses, all right? So simplest to simplest, okay? Now, you can take two different sides of things, right? You can buy an option, and you can sell an option. So first things first, what the heck is a call? Technically, what are you agreeing to do? So you are agreeing to, you're entering into a contract where you have the choice, but not the obligation, to be able to purchase stock at a certain price. Okay. So if the current price of the stock right now is at 116, so we're chilling here and we're at 116, and you go, you know what? I want to purchase this stock at 130 bucks. So you buy the $130 strike calls. If you buy one contract of this, you are controlling 100 shares. So you're agreeing to purchase 100 shares. Well, I guess you're not agreeing to, you have the option to purchase 100 shares at 130 bucks. Okay. That is with a call. Okay. Remember, we said the value of these calls increase as the price goes up and they decrease as the price goes down. So if you spent $2 to get into this contract to purchase shares at $130 on this specific stock, you've got to times that by 100 because it is $2 share. And if you're controlling 100 shares with this contract, so really you're spending about $200, right? For this contract, if it cost you $2, okay? If the price moves away from your strike, so if the price moves down, remember the value of these calls are going to do what? They're going to move lower. So now the value of this call is probably only worth $1.50. So if you went and sold this contract to purchase 100 shares at $130 to someone else out there, they're going to buy it from you for $150. So $1.50 times that by 100, 150 bucks. So you just lost $50 on that transaction. If the price doesn't go down, what if the price moves up? The value of those calls just increased. And let's say, for simple math, let's say they're now worth $2.50. Or times it by 100, they're worth $250. My pen is not happy and my handwriting is not great to begin with. $250. So if you were to turn around and sell this contract to someone else, you would make $50, right? You spent $200 for it. You could sell it to someone else for $250. You're making money. This is how most transactions happen with options. Most people actually don't care for the shares. They just simply want to flip the contract, so to say, right? They want to buy it for $2 and get out of it for $2.50 or $4 or $5, whatever the case is, okay? And of course, the higher the price goes, the more valuable this option now becomes. Now, once an option becomes in the money, right? So remember, we agreed, we had a contract to buy shares at $130. If the current price now that you've owned this contract to purchase these shares. If the price now has gone up to, let's say, $150, you now own something that's very, very valuable, right? You own something. You could turn to anyone and say, hey, the current price is at $150. I own an agreement to purchase this at $130. So either you could just exercise it and say, yeah, I want to buy shares here at $130. Remember, you've got to buy 100 at a time per contract. Okay. So if you had 5 contracts, you got to buy 500 shares. So you are sitting on something pretty nice, right? You still need to come up with the money to buy 100 shares at $130 or whatever your strike is. So you still need to come up with that money to purchase those shares. It's not free, but you have the you have the right to purchase them, right? You don't have to, you're not obligated to, but you have the option to. You could just flip this and sell it to someone else for a really hefty profit, or you can exercise this and immediately take the equity that you have, right? The stock's at 150, you immediately own this thing at 130. Jackpot. There's going to be a lot of people that are going to pay a pretty good penny to buy this contract from you because it's worth something, right? Now, here's the caveat. This sounds really, really good, but every single contract that we're discussing here has an expiration, okay? It could expire in 1 day. It could expire in 300 days. It depends on you of which one you bought. The larger the expiration time to expire, the more money it's going to cost. The shorter, the less it's going to cost. But an option needs to be in the money by expiration to be worth anything. If an option is outside of the money, so if I deleted all of this and we went back here to remember the prices, let's say the price is down here, and we bought the 130 strike, and the price makes it all the way up to 125. And it expires tomorrow. Okay. So you've been in this now for 4 days and it has 1 more day left till expiration. The value of this is completely different if the stock was all the way up at 150 with 1 day left till expiration. And why is that? Why? Because if a stock is not in the money, which means if for a call, if it's not above your strike price by expiration, it's worth 0. So right here, if the price is at 125, what are the probabilities that this could be in the money? What are the probabilities that this could go up $5 in 1 day? It's possible, but if the stock has an average daily expected move of $3 in a day, is it probable that it's going to go up $5? Again, it's possible, but the odds are low. That is going to crush the value of this option because someone's looking to purchase this and go, I'm going to purchase this. I'm not going to spend, $5 for this contract. I'll probably buy it for 50 cents because the probability that it's actually going to move more than its expected range in a day for this to be worth something is very low, right? And if they were looking at the actual logic side of this is like, hey, this is a contract that I could purchase shares at $130. Who the heck would want to exercise that contract when they could just purchase it on the market right now for $125, right? No one's going to. So the value of this option is extremely low. If someone did buy this for 50 cents and it did make a massive move of $6 the next day, which isn't probable, but it's possible, this is quickly going to turn into something very, very expensive. It's going to go from 50 cents, let's say, to $3. Boom. You just leverage that money, right? You spent $50 and boom, that thing just turned into a massive, massive amount, right? We add 2 zeros onto this guy. Boom. Or I'm sorry, 1 0. Move the decimal over 2 places. 1 0. Boom. You made $3,000 on. That's insane. Again, the probability of that happening, very, very low, but it could happen, right? So, and again, these are all made up numbers and it's probably not going to, whatever, but you get the point, right? You're spending $50 on something that could turn into $2,000 in a day because you're leveraging this. right? And so that's the benefit of options. That's one thing. That's what a call option is. Now let's talk about a put option real quick. So this video isn't a week and a half long. A put option. What the heck is a put? A put is insurance on the market. So let's say you owned $100,000 worth of shares and the stock is at all-time highs, screaming up, and everyone's scared that this thing's going to go down. So you have two options. You can either, or three, you can either just do nothing. Option number one is just ride it out and see what happens. Or option number two, you could sell everything. But if you sell everything, what if it continues to go higher and never pulls back? And you're like, man, I bought this 20 years ago and now I'm out and it's going higher. So now I have to buy it all the way up here if I want to get back in the market, right? That option sucks. Option number three, you could stay in your shares and buy insurance. So that insurance is going to protect you on any move down. It's going to make as much money as your shares are losing, depending on where you bought your strike. So if your strike price is where the insurance kicks in. So if the current price is up here at 155 and you bought the 150 strike put, as soon as the price goes below 150, those puts are now going to kick in. Your insurance is going to kick in and it's going to offset dollar amount. Remember, each contract is worth 100 shares. So if you had 1,000 shares, you'd want to buy 10 puts. And each dollar that your shares lose, those puts will gain that dollar amount back for the most part. It's going to balance its way out, right? If this thing moves way down, remember we talked about puts gain value as the price moves down. You can either turn around and flip this contract, right? So you spent $1 on these puts and these puts are now worth $6. You could now turn around and sell this contract to someone else for $6 and you can keep the profits. Or you can turn around and go, all right, I do want to exercise this. And that put, you can say, sell my shares at whatever my strike was at. Okay. So those are your options with puts. That's what a put is. And it's the same concept, right? If you bought the 115 strike put and the price moved all the way down to 120, but it didn't get down to 116, your insurance has not even kicked in yet. So it's going to expire worthless. You're going to lose whatever money you spent on it. Okay. So quick little rundown, puts and calls. That's what they are. How can you use them? Okay. One of the greatest ways to use options is with a very, very small account. If you have a small account, right? Let's say you have $5,000, $5,000, and you go, all right, I could buy 3 or 4 shares of this stock. I could buy 10 shares of this stock, and that's all I can really afford. That's a huge chunk of my account. And if the price goes up 2%, cool. I make 2% on, whatever the amount of shares I bought or whatever. If you put your entire account in there, you make 2% of that. Sweet. That's cool. Or you could take this same $5,000 and you can, remember we talked about earlier with contracts, they control 100 shares per contract. And if one contract only cost $1, which again, you got to times by 100. So really, if one contract costs $100 and you've got $5,000, and so you then turn around and say, I don't even need to put all $5,000 in my account on this, right? I could just, let's say I buy 10 contracts. You're now controlling 1,000 shares with $1,000. Whereas if you were to buy 1,000 shares of this stock, it would cost you $80,000, right? How cool is that? So you can use options with these contracts to control a large amount of shares with very little money. So when the stock moves up 2%, you're making 2% on the amount of shares, so to say, right? There's different things that go into option pricing. And we'll get into that, but this is just to prove a point, right? You can control a large amount of money with a very small actual investment with options, puts and calls. How cool is that? I would say that's one of the coolest benefits of step number 1 is that learning options and learning how they play. There is more that goes into it, but again, this is just a basic rundown to get you introduced to options. That's step number one, is you can make a lot of money. You can double your account in 2 days instead of making 2% of your account in 2 days. All right, awesome. Cool. The next little step, you can day trade with options instead of shares and do the exact same thing. So just so you know, you still have pattern day trading rules in effect with options, but if you have a very small account, you can now leverage these options in the same way that we just talked about on a daily thing. So, I mean, you could be doubling your investment on a daily basis with day trading. And so leveraging that is a really cool way to day trade with options. I highly recommend you day trade SPY starting out. That is the easiest one to control risk on. It's the most liquid, meaning you can get in and out very quickly. It's less of a chance of getting burned. Okay. So day trade SPY, that has expirations every Monday, Wednesday, and Friday. So if you just traded those days, you could avoid pattern day trading rule anyways and still make a lot of money day trading. Again, options are fantastic and a great way to leverage a small account. Another really cool thing you can do with options is to get paid to do something that you are already going to do. So let's say stock XYZ is trending really, really nicely and it's starting to pull back some. And you're like, man, it's only at $125, but I would love to own this at $100. And so most people just sit there and wait for it to get down to $100 and then they buy it. People that understand options realize, again, you can get paid to do something that you were already going to do. You were already going to purchase 100 shares at $100. You have the money for it. You were ready to do it. You're just waiting for the stock to get down there. Well, while you're waiting for the stock to get down there, what if you sold a put? Whenever you sell a put, you are agreeing to purchase 100 shares at the strike price that you choose by the expiration. So if someone were to pay you $500 to purchase their shares from them at $100, I was going to buy shares at $100 anyways. I might as well get paid $500 to do it. And that $500 is yours, no matter what. Few caveats. You only buy the shares if the stock closes below $100 by expiration. So if you sold this 2 weeks out and the stock comes down to here in 2 weeks, you don't buy the shares, you keep the $500 though. And then guess what you can do? You can turn around and sell the $100 strike all over again for 2 weeks. And if this thing bounces up to here, you still did not buy the shares, but guess what? You wouldn't have bought the shares anyways because it still hasn't gotten down to $100 yet, right? But now you just made $1,000 while you're waiting to do something that you were already going to do. So let's say you sold it finally the third time for another $500 and it finally comes down and it closes at $90. Cool. You just bought this at $100 and you've made $1,500 while you've been waiting to do that, right? You got paid $1,500 to do something you were already going to do without anyone paying you. Free money, my friends. The downside to this is you now own stock at $100, even though the stock is at 80 or $90. But guess what? If the stock was on its way down, you would have bought it at 100 anyways, which means you'd be in it even with it going lower. So don't freak out about that. You're in at a good price. So now that the stock has gone down to $100, right? It's come up, it's gone down, and you now own it. And guess what's going to happen in about a month or so? It's going to bounce and it's going to rampage. And now you're up here. So now you're debating, do I sell this? You could, or guess what? You could get paid money to do something you were already going to do. So if 140 was your target the entire time, so when you got down into here, you're like, man, it'd be amazing if we could get to 140. That would be a huge win. It'd be amazing. The stock is currently at 125. It's not at 140 yet, so you're not selling yet. But guess what? You can enter into a contract to sell your shares to someone out there at 140, and guess what they're going to do? They're going to pay you money to do it. So let's say, again, they pay you $500 to sell your shares to them at $140. I was going to do that anyways. Remember, the same concept applies. It only sells your shares if it closes above 140 by expiration. So if you sold this 30 days out, and in 30 days, it's right here, down at 120 now, You made your $500, you still have your shares. If you then wait for it to bounce and you sell it again at 140 and it goes all the way to 135, by, another month later, you make another $500 and you still have your shares. If you sold it again and then it goes all the way up to 150, this is the downside. You have agreed to sell your shares at 140. So if this thing goes to $200, you still have to sell it at 140. But that's what you were going to do anyways, because guess what, my friends? If the stock gets to 140, you would have sold it. You would not still be in for it to catch the $200 anyways, right? You were going to do that anyways. Don't think you're going to just hold out. Maybe you were, most likely you weren't. And in the meantime, you still sold it at 140, the price you want, and you made an extra $1,000 doing it. So what I do is I turn this into a money-making machine. So you could do this in retirement. You can do this in all kinds of different accounts that you already have, of saying, look, it'd be a joke if I sold this stock at 140 because currently it's at $100. That'd be amazing. And guess what? There are ways to get out of this contract so you don't actually have to sell your shares, but still get paid money to do it. Okay. So on every single dip, if you know the S curve, check out the courses here at Real Life Trading if you don't know how these markets move. Because if you don't know how the markets move, you're screwed. You don't know, it doesn't matter what strategy you do, you're going to do it at the wrong time and never make money. What's the next step? A pullback. So if we're making all this move higher, instead of losing money on a pullback that we know is going to happen, how about we sell a covered call up here at the spot we were going to sell anyways? And remember what happens to calls as the price moves down? The price of these calls go down with it. So if you sold it for, let's say, $500. So someone paid you $500 to do this contract. I'm just keeping easy math. It's going to fluctuate. Let's say someone paid you $500 for this and the price moves lower. The contract value of this is now only worth $100. So for you to get out of this, you need to buy it back. So if you spent $100 to buy it back, what are you walking out the door with? $400 profit, right? You got paid $500, you spend $100 to get out of it. You no longer have a contract over your head to sell your shares, and you just made $400. What's going to happen next on this S curve is going to bounce, and then you repeat the process again. So on every one of these dips, you are making money. And depending on the size and the amount of shares you have, you're making a lot of money. You could be making $400. You could be making 10 grand on every one of these dips. That's a free $10,000. Didn't cost you a dime, didn't add any extra risk, nothing. You're just simply getting paid money to do something that you are already going to do. I was already going to sell it at 145. Someone who wants to pay me $500 to do something I was already going to do. So options are amazing. They are not something to be scared of. You just need to know how they work. You need to know how the markets work, why to do what you're going to do, when to do it, right? And you won't get burned. People get burned when they don't know what they're doing. That is what you want to avoid. Learn how these things work, because it is such a huge benefit to know options. You can leverage a tiny account and turn it into something huge pretty easily. You can get paid money to do something you were already going to do. Instead of sitting on your hands waiting to buy, you could be getting paid while you're waiting to buy at the spot you were going to do anyways, right? So cool. So many ways to make money with this. Now, my favorite way, my last little method here, I know this is a little bit longer of a video. My last method of what I love about options is strategies using options that have a very, very high win rate with a very consistent pay. So credit spreads are one of those. What the heck is a credit spread? A credit spread is selling an option and buying an option at the same time. They're going to have different strikes, but the same expiration. Okay. So I'm not going to get into the details of what a credit spread is. I have other videos out on YouTube. Look it up for how to use a credit spread. But these credit spreads are awesome because how often are you correct on the move, but you're wrong on the timing? So you're like, okay, this is going to bounce. And so you get in and you buy shares, you buy calls, whatever you want it to do, whatever's going to try to make money on the way up. And then it does this. And then you get stopped out. And then a week later, it does that. Right? It happens all the time. The cool thing with credit spreads is you win as long as it stays above your sold strike. So when it came down to here, when everyone else is buying calls, I'm selling a credit spread all the way down here. And I'm getting paid $1,000 to do that. Now I make $1,000, I keep $1,000, I win on this trade as long as the price stays above this line, my sold strike by expiration. So even though it dove down, I still won. When everyone else got stopped out, I win. And so that's a really cool way. There's so many different strategies out there that give you a really high win rate because they give you a cushion to be wrong. I have this entire area to be able to be wrong. I don't have to be perfectly correct. I just have to not be dead wrong. And how often are people not perfectly correct? They're just not dead wrong all the time. In fact, beginners starting out in the markets, I would say that's majority of you. As soon as you kind of have an idea of what you're doing, it's like, oh, it went to target after it stopped me out. Oh, it did do that. It just didn't do it when I thought it would. Selling options, selling credit spreads are going to be your bread and butter to bring in consistent income. My friends, I made $2,000 a week with a $15,000 trading account simply doing credit spreads. Ridiculous. I was doubling my account every few months on average. And all I was doing was and this was when I was first starting out learning how to trade. I was good enough to not be dead wrong very often. I was still dead wrong a few times. You're always going to be, but I had a hedge strategy in place if I was, so I could turn a loser into a winner. Again, dive into my credit spread course and stuff if you want to learn how to do that. I show you exact strategy that I use to double my account literally every month and a half to 2 months. But this gives you that cushion, that little bit of lenience. You don't have to be perfect. And that is one of the biggest benefits with options is the strategies out there allow you to, as you're learning how to trade, give you something that you don't have to be perfectly correct on and yet still make massive returns. Okay. So those are my few little tips here with options of how you can use them to your benefit. A few warnings, because options are amazing. Realize that whatever you spend on an option, it is possible for you to lose that investment. So if you spend $5,000 on an option, it is possible for you to lose $5,000. Okay. A little other warning and a few tips to kind of help you with this. Whenever you are buying an option, this does not apply to selling, but whenever you are buying an option, which is what 99% of the people out there are going to be doing, if you go the cheapest route, you will struggle to make money. Meaning, it's like I could buy an option at the money where the current price is, and it's going to cost me $1,000. Or I could buy an option way out of the money and it's only going to cost me $200. There is a reason why it's cheap, my friends. It's because it's a lotto ticket. It's got a 5% chance really of ever making money. So yes, you could only lose $200, but you've got a 95% chance that you're going to lose. Whereas with this at the money, yes, this costs $1,000. I could lose $1,000, but I've got a 50% chance of actually making money. And realistically, if you know how to control your risk, you know how to trade, you're not going to lose the full amount. You're going to lose a portion of that, maybe 30% of it, right? So I'm going to lose $300, but now I have a 50% chance of actually making money compared to nearly a guaranteed chance I'm going to lose that $200. So that's tip number one. Tip number two is go out further in expiration than you think. Okay. So if you think the move is going to happen in 1 week, buy it 3 weeks till expiration. If you think the move is going to happen in 1 month, buy the 3-month expiration. Give yourself time to not have to be perfectly correct. Okay. Those few tips will help you tremendously when it comes to buying options. Those are the biggest mistakes that I've seen over the years and years of coaching people how to trade and make money and living with options. They always go the cheapest route. They go the shortest expiration and the furthest strike out. And you're setting yourself up to struggle to make anything. You're guaranteeing yourself a loss almost. So find a middle ground, learn how to leverage these things. Options are an awesome way to make massive returns with a smaller account. They're an awesome way to leverage money with a large account and get paid to do something that you are already going to do. And so many more benefits out there. You just need to learn how to do them. So have small size, Don't assume, don't try to be a millionaire overnight. The market will always punish people that try to make get rich quick schemes in the markets. So if you're like, I'm going to make $10,000 in one day, that'd be amazing. And you have a $3,000 trading account, you're just going to lose your $3 grand. You might hit that winner and make 10 grand. And guess what you're going to do next? Okay, well, I made 10 grand. I'm going to take this 10 grand and turn it into $1 million. And you'll lose your 10 grand. Eventually, you're just going to go broke. It does not work that way. Markets are not gambling. Gambling is I put money in and I pull a slot machine and I lose everything or I double it. That will never work in the markets, because the markets, you're going to have a 50% win rate. It's never going to work. The math does not work. The only way to make money in the markets are control your risk. So if you could lose $300 when you lose and you can make $1,000 when you win with a 50-50 win rate, you're going to make some money, right? That's the mentality you've got to have in trading. Leverage options, but do it smartly. Don't get caught in all the traps that people try to have and all the stories of how someone made $1 million, because it's just a matter of time before they lose it all. And it happens 98% of the time. Okay. Love y'all. Thanks for hanging out. Thanks for learning about options. That is it. If you have more questions, go to reallifetrading.com. We have tons of free content, tons of free courses out there to help get you on your feet and get you making money in these markets. If you have any questions to me, you can always email me, Tony, Tony, @reallifetrading.com. See you later, guys.